Traders, hey, great to have you with me today. Welcome to Money Rain. And today we're going to take a deep dive into the ATR Forecaster. Gotten a couple questions about it, and hopefully I can cover some of those here, and we can find out some of the gems and see how we might best trade it and get profit from it. So let's take a look. What I've got here is a 5-minute chart of the NASDAQ today on the 25th of July. Busy day, big day. Wow, if you were here after the close, after 1600 hours Eastern time, we definitely saw some volatility. But the ATR Forecaster indicators on this chart, and I've also got two moving averages. I've got a 100 period EMA and a 50 period EMA. Very simple. And the ATR Forecaster, and what that does is it plots this green dot, it plots this magenta or pink line. It's got this green line, it's got these red dots, and this kind of area in between here, this kind of grayed out zone. This zone is what I call the no man's land. It's kind of the middle price of the day, and as the mid price rises, as we find new highs, the mid price will rise. Between the high and low of the day. So that mid price, went up. So this is an uptrending day, definitely. And what we do is we project the daily average true range, the ATR, onto the mid price. So the average true range of the NASDAQ right now is running at, on a daily basis, we've seen a lot of volatility come in, 860 ticks. Okay, so that's the ATR today, 14-period daily ATR. And so we're centering that distance along the midline of the mid price of the day. So as prices rise, we get closer to the green and the magenta area, this area here, and we might get closer to the bottom area too on a down day. And what we're looking for is when we reach this zone between the green dots and this magenta line or this pink line, we're going to look for a reversal because we've hit the average true range of the day. Once we're in this zone, we've gotten pretty close to it. Once we hit the green dots, we actually have hit the daily ATR for this instrument. So we look for reversals. And that's what happened today. So it was a good example of this indicator in action. We had an update, continuous update. We finally broke into this zone, which is it's a few percentage points off of the average range. And once we hit that, the indicator starts printing now these magenta parabolic SAR dots, and we're looking for a reversal. And parabolic SAR is just a classic way to find reversals. Once we hit that level, we started looking for selling, and the market definitely sold off today. I wasn't trading the 5-minute chart, and I'll show you what I was trading here. I was trading this on the 100 tick. Now, a 100 tick chart, it definitely moves. There's a lot of action in the NASDAQ. Not too bad during the middle of the day when I started trading it. This was about 247-ish or so when we finally exceeded that pink line. So you'll see here, if I shrink it down, we've still got all those lines that I showed you before. We've got the overbought area down here, we've got the oversold, and we've got no man's land. What I do look for, though, is the minute we start hitting that magenta area, we start looking for those parabolic SAR dots again. And that's what the trades were today. I keep an eye out for that. Keep my risk small. Let's take a look at what, if you're classic, looking for classic support and resistance, you might be risking $65 to go from the parabolic SAR dot. If you'd entered just when price hit that parabolic SAR, which is right there-ish, if you entered there and you put a stop above that swing high, you were short here and you had a really nice rundown. Now, that's a little aggressive for some folks. I understand hitting a parabolic SAR, it's not really any meaningful level per se. And you might even see that it's at prior support. You know, if you were to draw a line here, this is now resistance became support, and we were going short right at that level. So maybe you didn't want to do that, and I don't blame you. It is aggressive. Risking $65 on a full-size E-mini is not too shabby, though. So taking that trade all day long for me, and that paid off pretty well. Had you taken that, you would have gone down to $215 in profit while risking 65. Now, what I like to do too is I like to consider going short when we hit the white line, which is 50. So once we've tagged the upper level and the parabolic SAR has been broken through, you can start shorting if you like at the 50 level. That's another entrance point. If you're going for a bigger move, going further down, you're looking for it to revert perhaps all the way back to this red line, which is the no man's land. You can also take a short here. I would use this as a trailing stop. Basically in any scenario, I like to use the 50 as the trailing stop. So this trade was a possible trade. Going forward though, had you missed that, you could come in again, and we had another touch of that overbought area, and it just started hitting right here. So that parabolic SAR hit there. You'd be risking $90 from that entrance to the high of the day. This ended up being the high of the day today, right around the 736 level, and ride that for a short. Confirmation on this was big right away when we got to the 50 going under the 100. So definitely an opportunity there. So this is the ATR indicator in action. You're looking for asymmetric risk patterns. What is asymmetric risk? I tell you, if you want to learn about minimizing your losses and maximizing your gains, you need to know what asymmetric risk is. Asymmetric risk, some folks, some traders would even consider, I know this is crazy for some of us, you exit the moment that you're in a loss. So let's say, for example, we went short right at the close of this red bar. And not a bad idea, right? We hit that parabolic SAR level. We go short right at the close. And the minute that we went up and we closed above that entrance, an asymmetric risk pattern would be to exit right at that point. You're in a loss. The trade immediately moved against you. Do not risk all the way up to your maximum list. Again, this risk was, I think it was $65. So $60 if you went short at the close of that bar. You're risking $65, and the market never touched it. But had you gotten out quicker, you would have risked and lost $25, right? So very small amount of risk. That is a small risk compared to that $200 gain that you could have when we rode this thing all the way down to the bottom. So asymmetric risk is very important. You can take $25 losses much more frequently than you can a $60 or a $90 loss. And something you want to think about. Of course, an asymmetric risk person would look for a breakthrough of this level and perhaps trade again when it either broke that level again or when it retraced up to it. Exit out here again if you want, another $20, $25 loss. And then the minute it broke through again, you could go short, put your risk there. The market never came back up to here before you hit your targets. So you're risking $25, $50, and your possible gain in this situation was $215. So you need to learn about asymmetric risk. The biggest mistake in trading, the way that you blow out accounts, is to lose money. Right? That is what it means. And if you are in a losing trade, you cut your losses quick. You cut them short. You get rid of them. Asymmetric risk is the idea there. You don't want to take a risk of $1,000 and wait and sit on a huge position if it's moving against you up until $900 loss or so, and then decide to cut your losses. For example, let's say that you wanted to go short. This is a good level. Some people might think of going short when prices came back up to here. We went down. We had a good move against it. We kind of started finding a triangle pattern here. We started kind of making higher lows and lower highs. Let's say you wanted to go short right here. We went short there, let's say, hypothetically. Not a good option. You're already above 2 moving averages, right? Cut it short. When this bar closed and you were in a loss, get out. Go short again if prices come back to you. If you're interested in that level, go short when you hit the red dash line again. You can do that. You don't want to ride this losing short position all the way up. That's the point. There's no reason to do that because it technically could keep going up. We were at the high of the day. We were at near the, this was the high of the day up until that point. We were at the overbought area on the ATR Forecaster. Yes, that's all true. But still, there's no reason to sit on that loss. There's no reason. So asymmetric risk, very important. Keep your losses small as possible. And then ride the winners for 10x of what your loss is. For example, if you had gone short here, put a stop right above that big thrust bar that you went short on. You're risking $30. You risked $30 here to gain. If you held on to the position, the market is still going down as I write this. $30 risked would have gotten you $895 short. And that is called asymmetric. So it's not symmetric. It's not like one-to-one risk reward. It's much larger than that, and that's the way you stay afloat. Again, trading is about not losing money first. That's your first commandment. Do not lose money. You can go much longer if you just held on to your winners and cut your losses short. Very important stuff. So again, thank you so much for joining me. Any questions on this? Feel free to drop them here in the comments below. Email me. My email is given in the end of this video, and I'd love to hear from you. Again, God bless you. I hope you had a good day trading the NASDAQ today, and I look forward to talking to you and with you. Have a great day.